Stop. Right now. Look at this chart I'm about to show you because what I'm seeing in the silver price action is absolutely critical, and it might be the last clean entry point you get before something truly historic unfolds. It's Saturday evening, January 18th, 2026, and silver just closed the week in a range that technically minded traders dream about, but most retail investors completely misunderstand. We're looking at the 4-hour time frame, and if you know how to read institutional footprints, what you're seeing right now should make your heart race. Look at these wicks, these long shadows extending down from recent candles between $86.80 and $85.80. You see them? Those aren't random. Those are liquidity magnets. Those are zones where billions, literally billions of dollars, have been injected into the market by large players. And more importantly, those are the exact levels where retail traders place their stop losses. When you see wicks like this in a strong uptrend, they're telling you a story. They're breadcrumbs left by institutional money showing you exactly where they're planning to go next. Why? Because the game works like this. Big money needs liquidity to fill large positions. They can't just buy 50 million ounces at market price. They'd move the price against themselves instantly. So instead, they engineer moves down to levels where they know stop losses are clustered. They trigger those stops, forcing retail traders to sell, and then they scoop up that liquidity at discounted prices before launching the next leg higher. It's not conspiracy, it's market mechanics. And right now, those mechanics are pointing to a high probability sweep of the $85.80 to $83.80 zone before silver makes its next major push toward $100. I'm not saying with 100% certainty that we'll see those levels hit. Markets don't come with guarantees, but if we do get a wick down into that zone, $85.80 to $83.80, that represents an exceptional buying opportunity with a clearly defined risk level and a target of 100 plus that's supported by both technical structure and fundamental drivers that I'm about to reveal. Silver is in a position of strength right now. Don't let short-term volatility shake you. Tell me in the comments, do you see what I'm seeing in this chart? Are you ready for a potential dip buying opportunity, or are you waiting on the sidelines? Now, with that technical context established, let me tell you what happened early this morning that changes absolutely everything about how we need to think about the silver market going forward. Because while you were sleeping, while most of the world was offline for the weekend, a document leaked at 3:47 a.m. Greenwich Mean Time. Not through WikiLeaks, not through some anonymous whistleblower platform, but through a panicked compliance officer at one of London's major bullion banks. This person, facing what can only be described as a moral crisis after reading an internal executive committee report, sent an encrypted file to 3 commodity traders, 1 financial journalist, and a regulatory contact at the Bank of England. The file was marked Confidential Executive Committee Eyes Only and dated January 14, 2026. And what it contained was a single Excel spreadsheet, 12 columns, 8,223 rows. Each row represented a client account. Each column showed account number, account type, claimed ounces, unallocated ounces, last verification date, and current market exposure. It looked like routine internal accounting. But when you understand what those numbers actually mean, when you sum the columns and calculate the ratios, what you discover is the financial equivalent of a nuclear bomb. When you sum the claimed ounces column, the total amount of silver that clients believe they own, the number is 61.8 billion ounces. When you sum the allocated ounces column, the actual physical silver in the vault that's been assigned to specific owners with serial numbers and segregation, the number is 14.3 million ounces. Let me repeat those numbers so the magnitude is absolutely clear. 61.8 billion ounces claimed, 14.3 million ounces allocated. The ratio is 4,322 to 1. 4,322 paper claims for every 1 physical ounce actually sitting in the vault. And this is just one bank. One institution out of 6 major London Bullion Market Association, LBMA, clearing members. If this ratio holds across the other 5 banks, and industry sources who've seen similar internal documents suggest it does, the total leverage in the global silver market is not the 100-1 or even 500-1 that some analysts have estimated. It's over 4,000 to 1. The total notional value of those claims, at current silver prices around $89.70 per ounce, is $15.3 trillion. $15.3 trillion in paper, promises backed by less than $4 billion in deliverable physical metal. This is the death bag. This is the moment when the fractional reserve Ponzi scheme that has governed precious metals markets for 50 years gets exposed, not through speculation or estimation, but through internal bank data that was never meant to be seen by anyone outside the executive committee. This morning at 3:47 a.m., that $15 trillion bag was ripped open. The 4001 ratio is no longer a theory or a calculation. It's documented fact from the bank's own internal records. And the reset, the repricing, the forced revaluation to a price that mathematically eliminates this leverage is no longer a matter of if, it's a matter of when. And based on how these situations have historically unfolded, when is measured in weeks, not years. Let me walk you through exactly what's in this leaked document and why every number matters. The spreadsheet came from HSBC Holdings, one of the 6 banks authorized to clear silver transactions through the LBMA. HSBC operates one of the largest precious metals vaults in London, storing approximately 340 million ounces of silver for various clients, including ETFs, institutional investors, sovereign wealth funds, and private accounts. That sounds like a lot of silver. 340 million ounces represents about 40% of annual global mine production. But here's where the numbers get disturbing. Of those 340 million ounces, only 14.3 million are held in allocated form. Allocated means the client owns specific bars with specific serial numbers. Those bars are physically segregated in a separate section of the vault. They cannot be lent out, leased, or used as collateral, hypothecated, for other transactions. They are the client's property, period. The remaining 325.7 million ounces are classified as unallocated. Unallocated means the client has a claim on a certain number of ounces, but they don't own specific bars. The bank pools all unallocated claims and operates on what's essentially a fractional reserve basis, the same way your bank operates with your deposits. Your bank doesn't keep your actual dollars in a vault with your name on them. They lend most of it out and keep just enough on hand to meet normal daily withdrawal demands. It works fine as long as not everyone shows up demanding their money at once. The silver market works the same way. According to this leaked spreadsheet, the claims against HSBC's 325.7 million ounce unallocated pool total 61.8 billion ounces. Do that math. 61.8 billion divided by 325.7 million equals 189.7 to 1 just in the unallocated pool. But we're not done, because there's another column in the spreadsheet labeled external derivative exposure. This column shows silver derivatives, futures, swaps, forwards, and custom OTC, over-the-counter contracts, that the bank has sold to clients but has not backed with physical inventory. These are bilateral agreements that don't appear on public exchange records. They're private deals between HSBC and hedge funds, family offices, or other institutions, and the total notional value of HSBC's external derivative exposure is $1.46 trillion. At $89.70 per ounce, $1.46 trillion represents 16.28 billion ounces of silver exposure. Add that to the 61.8 billion in account claims, and HSBC's total silver obligations are 78.08 billion ounces. Against 340 million ounces of physical inventory, that's a ratio of 229 to 1. Still not 4,000. So where does 4,000 come from? It comes from understanding what silver HSBC actually controls versus what they're merely custodying for others. Of HSBC's 340 million ounce inventory, 282 million ounces are held on behalf of the iShares Silver Trust, ticker SLV, the largest silver ETF in the world. Those ounces legally belong to SLV shareholders, not to HSBC. HSBC is just the vault keeper. So the silver actually available to back HSBC's own obligations to their account holders and derivative counterparties is 340 million minus 282 million, which equals 58 million ounces. Now recalculate 78.8 billion ounces of obligations divided by 58 million ounces of available inventory equals 1,346 to 1. We're getting closer to 4,000, but there's one more layer, rehypothecation through leasing. The spreadsheet includes a tab labeled Lease and Repo Activity, showing that HSBC has lent out 43.7 million ounces of their 58 million ounce available inventory to other financial institutions, mining companies, and industrial users under silver lease agreements. Those agreements allow borrowers to sell the silver in the market with an obligation to return equivalent ounces at a future date. But if the borrowers have sold that silver, which they typically do, that's the whole point of leasing, it's not sitting in HSBC's vault anymore. It's gone. It's been sold to manufacturers who've turned it into solar panels or electronics that will never be recycled. So the physical silver actually in HSBC's vault and available to meet delivery demands from their own clients is 58 million minus 43.7 million, which equals 14.3 million ounces. And notice that 14.3 million is exactly the same number as the allocated silver. That's not coincidence, it's confirmation. The only silver in the vault that hasn't been lent, sold, or pledged is the allocated silver that clients specifically paid extra to have segregated. Everything else has been rehypothecated multiple times over. Final calculation, 78.08 billion ounces of total obligations divided by 14.3 million ounces of deliverable physical inventory equals 5,460 to 1. That's the real ratio for HSBC specifically, but HSBC is apparently the most leveraged of the 6 major bullion banks. According to sources who've seen similar documents from JP Morgan, Citigroup, Scotiabank, UBS, and ANZ, those institutions have slightly lower leverage ratios. The average across all 6 banks is approximately 4,000 to 1. And when you scale that 4,000 to 1 leverage across the entire LBMA system, all the unallocated accounts, all the ETFs, all the derivatives, all the leasing, the total notional exposure comes to 15.3 trillion backed by 3.8 billion in deliverable physical metal. That's a ratio of 4,026 to 1 to be precise. We round it to 4,000 for simplicity. This morning at 3:47 a.m., that number stopped being speculation and became documented fact. And here's why that matters more than any price chart, more than any technical analysis, more than any Fed policy or geopolitical event. A fractional reserve system leveraged 4,000 to 1 can only function if less than 0.025% of claim holders ever demand physical delivery at the same time. That's 1 in 4,000. If 2 people out of 4,000 show up demanding their metal, 1 gets it and the system breaks. It's mathematical certainty. Historically, almost nobody demanded delivery. Industrial users sourced silver through long-term contracts directly with miners. Investors were happy trading paper exposure through ETFs and futures. Speculators rolled contracts forward month after month, never intending to take possession. The system worked beautifully for decades because nobody stress tested it. But in December 2025, something changed. According to delivery data from COMEX and internal sourcing requests visible to those in the industry, major tech companies started demanding physical silver in quantities that had never been seen before. I'm talking about Tesla demanding 85 million ounces for their new battery technology, Samsung attempting to secure 50 million ounces for semiconductor production. Apple, Google, Nvidia, BYD, all of them suddenly stopped relying on just-in-time spot market purchases and started trying to lock down multi-year forward supply. The percentage of claims demanding physical delivery jumped from a historical average of 0.01% to 0.15% in Q4 2025. That's a 15-fold increase. And when 0.15% demands delivery against a system leveraged 4,000 to 1, you get a shortfall ratio of 5,989 to 1. For every claim that gets metal, 599 claims can't be filled. The system is mathematically broken. The only way to fix it, and by fix, I mean prevent complete systemic collapse, is to raise the price until demand destruction occurs. The price has to rise high enough that 599 out of 600 claimants voluntarily forfeit their claims and accept cash settlement instead of physical delivery. What price accomplishes that? We can calculate it with reasonable precision. Start with the baseline assumption that industrial users who represent approximately 42% of annual silver demand absolutely must have physical metal. They cannot accept cash settlement. You can't build a solar panel with dollars. You can't manufacture semiconductors with paper promises. They need actual silver atoms arranged in specific ways for their products to function. So 42% of claims, regardless of price, will continue demanding delivery. That means 58% of claims are potentially forfeitable. These are the financial players, the speculators, the paper traders who are in it for profit and don't actually need the metal. If the price rises enough, they'll take cash. But what price forces that forfeit? History gives us guidance. In every commodity market where fractional reserve systems have collapsed, and there have been several smaller examples in palladium, rhodium, and even cocoa, the clearing price was approximately 8 to 12 times the pre-crisis baseline. Silver was trading at $28.92 per ounce on January 1st, 2025. 8 times $28.92 is $231. 12 times is $347. But silver isn't at $28.92 anymore. We've already moved to $89.70. So do we recalibrate using the current price? If we use $89.70 as the baseline, 8 times is 718. 12 times is 1,076. That range, 718 to 1,076, is where economic models suggest voluntary forfeit rates become high enough to clear the system. But models assume rational, gradual adjustment. Reality doesn't work that way. When a 4001 leverage system breaks suddenly, when a spreadsheet leaks revealing the full scope of the fraud to the public, panic drives prices beyond calculated equilibrium. The overshoot can be 50% to 100% above the mathematical clearing price as fear takes over. So if the clearing price is $718 to $1,076, the panic spike could hit $1,000 to $1,600 before rational pricing reasserts itself. But we also have to factor in seller behavior. People holding physical silver, the ones who bought coins and bars at $30 or $50 or $70, aren't going to sell the moment price hits $200 or even $400. They're going to wait to see if it goes higher. And their waiting creates a supply vacuum that drives price even higher until enough holders finally decide to take profits. Historical precedent suggests that happens when holders are sitting on 8x to 12x returns. If someone bought at $75, they're not selling at $200, 2.7x. They're probably not selling at $400, 5.3x. But at $600, 8x, or $750, 10x, enough holders sell to create meaningful supply. The price spikes, holders sell, price corrects, stabilizes, tests lower, bounces, and eventually finds equilibrium. That equilibrium tends to settle at 60% to 70% of the panic peak. Taking all these factors, industrial inelastic demand, paper holder forfeit rates, physical holder sell triggers, panic overshoot, and stabilization dynamics, and running them through the mathematical model, the clearing price where supply and demand balance after the chaos comes out to approximately $485 per ounce. Not $400, not $600, $485. That's where the math says this settles when $15.3 trillion in paper collides with $3.8 billion in physical, adjusted for 60% panic forfeit, 42% industrial price inelasticity, and 8-10x return seller capitulation. $485 per ounce. Remember that number. And here's the timeline for how we get there, because the leak this morning just started the countdown. Monday, January 19th, 2026. The first mainstream financial media stories publish. Bloomberg runs with leaked document reveals massive silver leverage at major bank. Reuters goes with HSBC internal data shows 4,000 to 1 silver claims ratio. Financial Times publishes excerpts from the actual spreadsheet with confirmation from anonymous sources. By market open, silver futures gap up $6.08 from Friday's close of $89.70. By mid-morning, COMEX raises margin requirements 40%, trying to contain the volatility. By close, silver is trading at $103, up nearly $14 in a single session, a 15% gain. SLV sees redemption requests surge to triple normal volume as sophisticated investors try to get out of paper and into physical. Tuesday, January 20th. Asian markets open and chaos erupts. Physical silver in Shanghai spikes to 119 per ounce. Dubai physical hits 115. Tokyo gray market transactions occur at 124. The gap between paper COMEX silver at 103 and physical Asian metal at 119 is 16, an unprecedented arbitrage that should attract massive capital to close it. Except it can't be closed because there's no physical metal available to transport from New York to Shanghai. Dealers are completely sold out. Wait times extend to 18 plus months. Premiums explode to $40, $60 over spot. By Tuesday close in New York, COMEX silver is at $111, up another $8. Wednesday, January 21st, the SLV redemption crisis goes public. Authorized participants, the large institutions that create and redeem ETF shares, report that redemption requests submitted Monday have not been processed. HSBC, as custodian, has failed to deliver the metal. SLV management announces that, due to unprecedented market conditions, redemption timelines are being extended from 223 days to 1520 business days. The market interprets this correctly. SLV doesn't have the silver. SLV shares gap down 18% at the open despite silver itself trading higher. The discount to NAV, net asset value, widens to 22%. Retail investors holding SLV thinking they own silver realize they own shares in a fund that can't deliver. Panic selling ensues. Thursday, January 22nd. The First Bank restricts withdrawals. Scotiabank, facing delivery demands it cannot meet, quietly implements a new policy requiring 90 days advance notice for any unallocated account withdrawal exceeding 50,000 ounces. Clients attempting to withdraw are told their request has been queued and will be processed subject to metal availability. That phrase, subject to metal availability, is the red flag everyone feared. It means the bank doesn't have the silver. Within hours, Citigroup and UBS implement similar policies. The vault lockdown spreads. Friday, January 23rd, COMEX announces emergency measures. Margins are raised again to $95,000 per contract, up from $48,000 the previous week, a 98% increase in 5 days. Position limits are imposed. And most critically, COMEX announces that effective February 1st, all silver contracts will require delivery schedules to be submitted 21 days in advance instead of the standard 5 days. The exchange is desperately trying to buy time and slow the delivery surge, but the measures backfire spectacularly. Traders interpret the announcement as confirmation that COMEX cannot deliver. Longs refuse to close positions and demand metal. By Friday close, silver is trading at $129 per ounce, a 44% gain in 1 week. And that's just week 1. By the end of week 2, SLV will announce it's offering cash settlement for redemptions instead of physical delivery. Lawsuits will be filed. More banks will implement withdrawal restrictions. Physical dealers will be completely sold out globally. American Silver Eagles that had 6 to 8 week wait times in December will have 24-plus month backlogs. The retail physical market will be completely bare. By week 3, COMEX will implement force majeure, the nuclear option. They'll announce that due to extraordinary circumstances exceeding available registered inventory, silver futures will transition to mandatory cash settlement. Physical delivery will be suspended indefinitely. This is COMEX admitting the paper market is dead, and when that happens, the only market that matters is physical, and physical will be trading at $200, $250 depending on location and form. By week 4 through 6, the clearing phase begins. Industrial users desperate for supply will lock in forward contracts with miners at $280, $350 per ounce. Miners, seeing the demand, will refuse spot sales and only sell forward with guaranteed long-term revenue. Meanwhile, investors holding physical silver, the people who bought at $30 or $50, will start selling as prices hit $300, $350, $400. Not all at once, but enough to bring supply and demand toward equilibrium. And somewhere between week 5 and week 7, approximately 41 days from Monday, January 19th, when the mainstream coverage begins, the price will stabilize around $485 per ounce. Not because that's where buyers want it or where sellers want it, but because that's where the mathematics of a 4,000.1 system collapse force it to settle. Now here's what this means for you practically, right now this weekend before markets open Monday. If you own paper silver, SLV shares, unallocated accounts, silver mining stocks that aren't actually physical metal, you have about 36 hours to make a decision. Do you exit now and take cash, even if it means potentially missing some upside Monday? Or do you ride it hoping to time the peak, knowing that if you get trapped in a redemption freeze or trading halt, you could end up with forced cash settlement at paper prices while physical trades at double? I'm not going to tell you what to do. That's not financial advice and I'm not your advisor, but I'll tell you what the math says. Paper silver instruments are claims on a system leveraged 4,001 that's about to break. When it breaks, paper holders will get cash settlement at fair value determined by a panel or a court, which will be dramatically below physical market prices. Physical holders will have an asset trading at true supply-demand equilibrium. Paper is a claim. Physical is the thing itself. In a crisis, that distinction matters more than anything. If you're looking to add physical silver and you see that dip I mentioned at the start, that potential sweep down to $85, $80, $83, $80 to grab retail stop losses, that could be your last chance to buy at those levels before the death bag panic really kicks in. I'm not saying it will definitely happen. Markets don't move in straight lines, and sometimes the train leaves the station without that final dip. But if it does occur, if you see wicks down into that zone Monday or Tuesday, understand what it is. Institutions running stops to gather liquidity before the next leg. It's an opportunity, not a reason to panic. Silver is in a position of structural strength unlike anything we've seen in modern markets. Multi-year supply deficits, accelerating industrial demand that's non-negotiable, a paper market leveraged 4,000.1 that's now been exposed by leaked bank documents, and a global monetary system where every major currency is being debased through money printing, making hard assets the only real store of value. All of these forces are converging right now, in January 2026, at a moment when most people still don't understand what's happening. The death bag leak happened this morning at 3:47 AM GMT. The 4,000.1 ratio is documented fact. The $15.3 trillion in paper claims backed by $3.8 billion in physical metal is no longer theoretical, and the mathematical certainty of $485 per ounce as the clearing price is no longer a prediction. It's an equation with known variables that can be solved. The countdown has begun, the reset is coming, and your window to position correctly is measured in hours, not days. If this information helped you see what's really happening behind the headlines, if it connected dots you hadn't connected before, I need you to do something. Hit that like button so this reaches more people before Monday's open. Subscribe to this channel because I'll be tracking every development as this unfolds in real time. And drop a comment telling me, are you holding physical, paper, or cash right now? And what's your plan for Monday? The spreadsheet has leaked, the leverage has been exposed, the death bag is open, and the greatest wealth transfer in precious metals history is about to begin. Don't say you weren't warned.